Gold just printed a number that should make every investor stop and think $6,000 an ounce. Not on COMEX, not in London, not on any of the traditional exchanges because they're closed. This price appeared on weekend trading channels in Asia while most of the financial world was offline. And it wasn't a small move. It was roughly $700 above Friday's close in less than 48 hours. That's not volatility. That's stress inside the system. And what makes this more serious is not just the number itself. It's where it happened and why. A bank warning that shouldn't be ignored. A regional Chinese financial institution, Zheshang Bank, reportedly issued a notice to customers warning that extreme price swings and tight liquidity could force a temporary suspension of gold-related services. Think about that carefully. When a commercial bank in the world's second largest economy warns that gold trading may be halted because supply conditions are unstable, that's not routine. That suggests physical stress in the pipeline, not futures contracts, not speculative bets, physical supply constraints. When financial institutions begin talking about suspending trading due to inventory strain, it signals something deeper than price volatility. It signals imbalance, and imbalance in precious metals markets can escalate quickly, especially during geopolitical shockwaves. What triggered the surge? Over the last several days, tensions in the Middle East have escalated dramatically. Military exchanges between United States, Israel, and Iran intensified following coordinated strikes on Iranian military infrastructure. Retaliatory missile launches followed. Regional capitals reported explosions. Air defense systems were activated across multiple Gulf states. Several U.S. installations in the region reportedly faced incoming projectiles. And then came the headline that sent shockwaves through global markets. Iran's supreme leader, Ali Khamenei, was reported killed in a precision strike. Whether confirmed, disputed, or partially verified, the market reaction tells you everything you need to know about how seriously traders are taking it. Gold doesn't move hundreds of dollars in a weekend because of rumors. It moves when risk perception explodes. Why this event changes the calculation in most military escalations: there's an off-ramp, limited strike, retaliation, diplomatic backchannel, cooling period, markets spike and then settle. But when leadership structures are disrupted at the highest level, uncertainty multiplies. Investors start asking different questions. Who is in control? Is there centralized authority to negotiate? Will retaliation escalate further? Could regional powers join? That uncertainty is exactly what precious metals price in. Gold is not reacting to headlines. Gold is reacting to instability. The Middle East. Flashpoint missile activity has reportedly affected parts of the Gulf region, including Dubai, Doha, Manama, Riyadh. When conflict touches energy corridors and financial hubs simultaneously, markets do not wait for confirmation. They price worst-case scenarios immediately. Airspace restrictions, shipping insurance spikes, energy supply risk, even the possibility of disruption to the Strait of Hormuz, which carries roughly 20% of global oil supply, can trigger commodity shockwaves. And commodity shockwaves feed directly into inflation expectations. Why $6,000 might not be the ceiling. Here's the key insight. The $6,000 weekend print is not a forecast. It's a live trade. Someone paid that price with real capital. During real conflict, when primary exchanges reopen, they must reconcile with where physical markets are clearing. If futures markets open hundreds of dollars below where physical buyers are transacting, arbitrage pressure forces adjustment. And if liquidity is thin, which is common during crisis opens, price gaps can be violent. Market makers widen spreads, sellers step back, buy orders stack. That's how vertical moves happen. The physical versus paper. Divide in calm markets, futures pricing dominates. In crisis markets, physical supply dominates. If banks begin limiting gold services due to inventory constraints, it suggests something critical. Physical demand is overwhelming available supply at current prices, and that creates a dangerous loop. Price rises. More buyers rush in. Supply tightens further. Institutions restrict access. Panic buying increases. We have seen versions of this during past crises, but rarely with this level of geopolitical tension attached. The silver situation, a warning sign. Silver's market is significantly smaller than gold's. In dollar terms, the entire above-ground investable silver supply is a fraction of gold's. That means moves can be more extreme. Industrial demand doesn't pause during war electronics, energy infrastructure, defense systems, solar manufacturing. Silver is embedded in all of it, and unlike gold, silver's supply chain has been running structural deficits for years, meaning more silver is consumed annually than newly mined. If gold is under pressure, silver can become explosive, not because of speculation alone, but because of scale. The energy link if. Tensions escalate around the Persian Gulf shipping lanes. Oil markets react instantly. Insurance costs rise. Freight premiums rise. Fuel prices rise. Higher oil feeds inflation, and inflation feeds gold. Central banks then face an impossible decision. Tighten policy into war-driven slowdown? Ease policy into oil-driven inflation? Neither is clean. And when monetary policy becomes constrained, investors seek assets outside the banking system. That's gold's historical role. The nuclear variable. Some analysts have raised concerns about potential escalation involving nuclear infrastructure or weapons capability demonstrations. Even discussion of such scenarios can cause capital flight into safe haven assets. Markets don't wait for confirmation of catastrophic events. They move on probability. If nuclear risk enters mainstream discussion among intelligence or defense analysts, gold reacts before anything materializes. Why this weekend? Matters. Let's zoom out. 5 days ago, markets were focused on routine macro data. 3 days ago, regional strikes began. Then, missile retaliation spread. Then, leadership decapitation headlines. Now, gold prints $6,000 in off-exchange weekend trading. A Chinese bank warns of gold liquidity constraints. Airports close. Energy risk rises. Oil volatility spikes. That's not a slow burn, that's acceleration. What happens when major exchanges reopen? When COMEX and London reopen, several forces collide simultaneously. Weekend repricing pressure, institutional hedging demand, retail panic buying, algorithmic volatility triggers, thin liquidity conditions. If physical buyers are clearing near $6,000, futures markets must adjust or risk dislocation. That adjustment can happen fast, very fast. The bigger picture, this isn't just about one price spike. It's about system confidence. When banks warn of gold shortages, military escalation. Intensifies energy corridors face, risk inflation expectations rise, capital migrates, not gradually. Suddenly, gold becomes less of a trade and more of a refuge. And when refuge demand outpaces available supply, price discovery becomes chaotic. Where we are right now, geopolitical escalation ongoing, regional energy risk elevated, precious metals repricing in real time, liquidity warnings emerging from financial institutions, markets about to reopen into maximum uncertainty. This is not a normal Monday open. This is a stress test. And what happens next depends on whether escalation pauses or expands. Because if further triggers emerge, and whether regional alliances enter, energy disruption worsens, or military confrontation intensifies, precious metals may not just spike, they may rebase. And if that happens, $6,000 won't look like a peak. It will look like the starting line. The real story is the cascade effect that follows geopolitical escalation, and how it spreads from energy to inflation, to central banks, to silver, and finally into the broader financial system. The oil trigger. The strait. That moves the world, everything hinges on one narrow passage of water, the Strait of Hormuz. Roughly 20% of the world's oil supply moves through that corridor every single day, and Iran sits directly beside it. Here's what most people misunderstand. Iran does not need to formally blockade the strait to trigger an oil shock. They only need to create risk. Missile strikes near shipping lanes, drone activity in tanker corridors, naval exercises that spook insurers. That's enough. Because oil markets are driven by expectation, not just flow. If shipping insurers triple their premiums overnight, refiners pay more. If refiners pay more, gasoline prices jump. If gasoline jumps, inflation expectations spike. And inflation expectations are what drive gold vertically. If oil breaks into the $150, $200 per barrel range, not as a worst-case fantasy, but as a sustained conflict premium, the entire inflation trajectory of 2026 changes. Central banks lose control of the narrative. The Federal Reserve's impossible position. Before this conflict, monetary policymakers were already cornered. Inflation had cooled but remained structurally elevated. Growth was slowing. Debt levels were historically high. Now inject energy shock risk, supply chain disruption, war-driven commodity inflation. If oil surges while global trade routes destabilize, inflation doesn't just tick higher, it reaccelerates. And the Federal Reserve cannot fight war-driven oil inflation in the same way it fights demand-driven inflation. Raising rates into geopolitical chaos risks triggering recession. Cutting rates into oil inflation risks currency devaluation. That's paralysis. And when central banks appear trapped, capital seeks assets with no counterparty risk. Gold thrives in central bank paralysis. Silver thrives when gold's strength spills over into smaller markets. Silver, the market. Too small for this moment. Let's talk scale. Gold is a deep, liquid global market held by central banks. Silver is different. Silver is part monetary metal, part industrial commodity. Its total investable above-ground supply is tiny relative to global capital pools. That means one thing: it doesn't take much new demand to move it dramatically. Now, layer in the current environment, silver demand comes from solar panels, electronics, manufacturing electric vehicles, defense systems, satellite infrastructure during peacetime. That industrial demand already pushes supply to its limits. During wartime escalation, missiles, radar systems, encrypted communications, guidance systems, they all use silver in some form. Military consumption accelerates. At the same time, investors fleeing paper assets begin allocating into physical silver because it's cheaper per ounce than gold and perceived as undervalued. That creates a squeeze dynamic. Industrial buyers cannot simply wait for lower prices. They need material to fulfill contracts. Investors, fearing shortage, remove silver from circulation. The float shrinks, and when float shrinks in a small market, volatility explodes. The supply side, weakness. Silver production is heavily concentrated geographically. Mining output doesn't respond quickly to price spikes. New mines take years to develop. Permits, infrastructure, capital expenditure, none of it happens overnight. If conflict expands or sanctions tighten in key producing regions, supply becomes even more constrained. Meanwhile, refining bottlenecks add another layer of fragility. If logistics are disrupted by fuel price spikes or regional instability, even mined silver can struggle to reach global markets efficiently. So the supply side was already tight before missiles launched. Now demand risk has multiplied. That imbalance is why silver often moves later, but harder than gold, the nuclear variable. There's another layer that markets are quietly pricing. Escalation risk involving nuclear infrastructure. Even discussion of nuclear capability demonstrations changes the calculus. If any country in this conflict signals expanded nuclear readiness, even symbolically, safe haven demand accelerates. Because at that point, the risk model shifts from regional war to systemic global instability. Central banks in emerging markets increase gold accumulation. Sovereign wealth funds rebalance away from vulnerable assets. Private wealth seeks portable stores of value. Gold reacts first. Silver follows with torque. The aircraft carrier scenario one of the most closely watched flashpoints is the deployment of U.S. naval assets in the Persian Gulf. Aircraft carriers are not just military tools, they are political symbols. If a major naval asset were successfully struck, escalation pressure would skyrocket overnight. Congressional pressure, alliance activation, broader military engagement, markets would not interpret that as limited exchange. They would interpret it as expansion. An expanded conflict means expanded fiscal spending. Expanded fiscal spending means more deficit issuance. More issuance means pressure on sovereign bond markets. If bond markets wobble while inflation rises, confidence in fiat stability weakens. And when confidence weakens, gold is not viewed as a commodity. It is viewed as monetary insurance. The bank liquidity signal. Let's return to something critical. When banks begin warning about suspending gold-related services, it suggests stress in allocation systems. Modern gold markets rely heavily on paper contracts and digital claims. Physical delivery rates are typically low, but during crisis periods, delivery requests rise. If too many participants demand physical settlement at once, vault inventories can tighten quickly. Even rumors of such tightening can spark demand spikes. It becomes self-reinforcing. And if this dynamic spreads beyond isolated institutions, confidence in paper gold contracts weakens. That's when price gaps become disorderly. Oil at $200. The secondary shockwave, imagine oil sustaining $180, $200 per barrel for several weeks. Transportation costs surge. Food prices rise due to diesel input costs. Airlines cut routes. Freight slows. Inflation becomes visible to consumers instantly. At that point, governments face political pressure to intervene, subsidies, strategic reserve releases, emergency measures, all of which increase fiscal strain. Higher deficits during wartime are historically normal, but higher deficits combined with inflation and geopolitical fragmentation is rare. In that environment, currencies can become volatile, and currency volatility feeds precious metals demand. The currency angle: if global investors perceive elevated risk in dollar-denominated assets due to military expansion and fiscal acceleration, diversification flows may increase. Emerging market central banks have been net buyers of gold for years. Conflict expansion only reinforces that behavior. Gold becomes a neutral reserve asset. Silver becomes the leveraged expression of that move. When markets reopen, the first full reopening of major exchanges after a geopolitical weekend like this is often the most unstable. Liquidity providers pull back, bid-ask spreads widen, algorithms trigger volatility halts. If gold futures open hundreds of dollars below where physical markets were clearing, buying pressure can gap them upward instantly. If they open closer to weekend pricing, short covering could amplify upside. Either way, volatility is almost guaranteed. Silver, being thinner, could experience even sharper percentage moves. The psychological component markets are not just math, they are emotion layered on top of math. Images of missile strikes, leadership of assassination headlines, airports closing, regional alliances threatening intervention. All of this builds a narrative of uncertainty, and narrative drives behavior. Investors who ignored metals at $2,000 gold suddenly panic at $6,000. That's how psychology works. Late demand is often the strongest demand. The 72-hour window right now, the world is in a fragile holding pattern. Several triggers could dramatically alter trajectory within days. Expansion of regional alliances, direct strikes on energy infrastructure, naval escalation, nuclear signaling, prolonged airspace closures. Any one of these intensifies capital flight into safe havens. Multiple triggers simultaneously, that creates disorderly repricing. The big picture. Let's summarize the cascade. Military escalation increases risk perception. Risk perception drives gold higher. Oil reacts to regional instability. Oil feeds inflation expectations. Central banks face policy paralysis. Currency confidence wobbles. Capital rotates into physical assets. Silver's small market magnifies volatility. That's the chain reaction. Gold at $6,000 is not the story. It's the warning light on the dashboard. The real question is whether escalation pauses or compounds. If diplomatic backchannels cool tensions quickly, metals may retrace some panic premium. But if even one major escalation trigger activates, we move into a different regime. A regime where metals are not trading on technical charts, they are trading on survival logic. Final thought markets can ignore tension. They can ignore rhetoric. They cannot ignore structural risk. Right now, structural risk is rising across energy, defense, currency, and banking channels simultaneously. That's rare, and rare environments produce historic moves. Whether this becomes a brief shock or the beginning of a multi-month repricing cycle depends on decisions being made in war rooms right now. But one thing is clear. The system is under stress, and precious metals are responding exactly the way they have for thousands of years when stress rises. The next few trading sessions may define not just the direction of gold and silver, but the tone of global markets for the rest of the year. Stay alert. This situation is moving by the hour.